2. What it do? It is your boy Young Soros here, back with another video. And in today's video, we are going to be breaking down the end of the stock market rally, the insane 16-week rally or 16-week stretch we have been on has finally come to an end, and I'm going to explain why, the warning signs, and I also got a couple keys for you in terms of what is causing the stock market to fall and hopefully, keep falling. So if you like what you're hearing, drop a like, comment, subscribe. Let's jump right into it. So starting with what happened last week. Last week was a doozy and a reality check for the stock market as we got bad inflation data, hawkish Fed speakers, a whole slew of bad data coming out last week, and it has been weighing heavily on the markets. And not only that, it has been weighing heavily on the Fed futures. I will get into the Fed futures in a little bit because that is what the main crux of this entire stock market rally has been based off of. But for the most part, the stock market got some bad news the last week, and we actually closed down on the week. That has been twice now we have closed down out of 16 consecutive weeks. That is an insane move, and these moves typically do not happen. You rarely see 16 weeks of straight green, straight positive, and this was the second week where you went red on the week. Now, with that being said, there has been a lot going on within the market, and it's just been ignoring it all. But as we get towards seasonality, as we get towards the back half of earnings, you will start to see the cracks within the market, and that is where fireworks will really start to pop off. And we also need to be taking a look at March. I'll get into that video later, but March is going to be a key month. But let's talk about what is causing the market to fall. Well, number one, earnings season is done. Now, with that being said, earnings season allows the stock market to kind of shrug off any bad news or anything happening anywhere in the world, because they're all focused on companies and how they're going to maintain their profits or anything related to the companies. So this allows the market to brush off any bad news, allows for some insane moves for certain companies, but it's masking the bigger issue, right? Now that we're getting into the back half of earnings, now that we're getting out of earnings season, you are starting to see the market react to more inflation data, more bad data, because before you could just easily shrug off any bad news because you had Meta earnings go up 20%. Meta is a big company, and Meta going up 20% really helped the stock market, especially if you're receiving bad news. That will really help the NASDAQ go up. That is why you had last week, or at least 2 weeks ago, you had that everything was red besides Meta. So that means the Magnificent Seven was holding up the stock market, and that is what's been going on for the past couple of months. There's been 7 or 6 companies within the S&P 500 and the NASDAQ holding up the entirety of the stock market, and that is not healthy at all. Because if those 6 stocks start to fall, you will see, bigger issues arise within the stock market. And as you can see, these companies all red. Nvidia barely red. Microsoft red. Apple, Google, Meta red. And what happened to the markets today? Red. So there is some pretty tight correlation with the Magnificent Seven, and all this stuff going forward. You got to keep that in mind. If you continue to see these 6 stocks outperforming the market, and then people are just buying, buying, buying. At a certain point, these six stocks are not going to hold any longer, and that is where you're going to get a bigger sell off. Now, with that being said, their earnings are out the way, and these little pockets of green that you see, Eli Lilly, MVO, AMAT, these are all earnings companies. Now, they reported earnings on Friday and they did good, so they were able to brush off the CPI effect. But you had some companies that weren't so lucky, that had earnings that weren't able to brush off the CPI effect. So now we're in this little weird spot on Friday. That's where you saw a lot of choppiness and a lot of volatility. And that is why you saw the stock market drop, run up, run down. There was a lot of volatility, a lot of moving parts. You had a VIX expiration that happened Friday. A lot of things happened Friday, and don't get too caught up into what happened Friday. Just know that seeing the inflation data come out as hot as it did, the CPI inflation, all that, seeing it come out as hot as it did or as high as it did will cause the market to fall, and also the Fed futures to fall as well. So that's key number one. Key number one is that earnings season is out of the way. Now the market has nothing to focus on, and it's going to be forced to look at the reality of what is going on instead of just being in this little earnings season mode. Now, key number two, you have been up for the last 16 weeks in a row. And I'm not exaggerating when I say this. Take a look at the SPY chart. You have been up for, look at all these green candles. Look at all these green candles. You have only had one other time where you have closed red on the week. And that is extremely concerning. That should concern you, because how sustainable is this rally? And where would you go back to mean reversion? So that means a big correction is going to have to come. And big corrections usually scare a lot of people, and that could be a buying opportunity for some of you guys. But, you know, if you're getting a big correction like this, and the VIX has been basically neutered for the past, 2 years or so, you're going to experience some extreme volatility. Now, with that being said, you have Nvidia earnings next week. They have ran up an absurd amount. Nvidia has been carrying the stock market basically single-handedly. And if we take a look at their chart, I mean, look at this thing. It has ran up an insane amount. And to expect this to continue, I mean, you would be a fool. You would be a fool to expect this to continue. But then again, I mean, look at the low. Look at the low it had 2 years ago. So, like I said, there's a lot that's riding on NVIDIA earnings next week. And that is why, I have, that is my second key, or my third key, I should say. NVIDIA earnings next week is going to disappoint the stock market. This thing has ran up so high. What is there to say about NVIDIA that will cause them to keep running up, or to consider this evaluations? And not only that, maybe this is a buy the rumor, sell the news event. Maybe they come out, they have good earnings, and everybody sells it off, that can happen. It could be a buy the rumor, sell the news event, but I do not see earnings taking this thing further than it is right now. Will it get back here? Yes, it will get back here, this year. But as of right now, you have had so many moves up to the upside after breaking out of this little 400, 500 channel. And once it broke out, I think it will come back down to 600. Maybe it will come back down to the little channel right there. I doubt it. But at the very least, it will come back to 600 and then, float there for a little bit and continue the rally. As for the S&P 500, if we take a look at the daily chart, I mean, you had just been going up, up, up for the entirety of this since October, really. And it is time to come back down to earth, and down to earth would be this 460 level right here, maybe 470. But if you really want to get into a downtrend, the stock market is going to fall to 450. Will I think it hit 450? No. I would think it's probably going to hit 480, 470 at the very most. And then if it keeps continuing from there, you're going to get an aggressive sell off and further consolidation. So those are the three keys bringing down the stock market. You got Nvidia earnings, you had bad inflation data, you know, and then you're at the end of earnings. Every company has reported already. There isn't really too big of earnings besides Nvidia, but other than that, there isn't really too much to watch for in terms of earnings. So the stock market can't just ignore everything that's going on. And what's interesting about everything that's going on, you take a look at the treasuries. Treasuries are back to where they were in October. And I don't know about you, but in October, you were hitting 400. You were hitting 400 on the S&P 500. So if this continues and we see yields keep rising and the treasuries keep dropping, the market is going to have to catch up to the bond market. And you don't want that because it'll catch up to the bond market really, really quickly. But like I said, we are at the same level as we were in October, and I don't know if you want that. Well, excuse me, October of last year. October of last year, you had a really, really, you were at 350 as a matter of fact. Right now, you're sitting at the same level you were at last October, and excuse me. Yeah, I'm doing. I'm tripping. Yeah, you were sitting at the same level as you were before you began October. So if the bond market keeps selling off, you're gonna see an aggressive sell off, and one of these are had to catch up to the other, whether that be the bond market or the equities market. Somebody's gonna have to play catch up, and it's not going to be good. Now, what am I doing to prepare for this stock market meltdown? Well, I made two trades on Friday that had me preparing for the stock market meltdown. The first, I bought these 475 puts. I bought five of these, and I'm up 64 bucks on these. And I opened them at 66 cents. They're already at 80 cents, so pretty decent profit. Pretty decent profit. I went with more time because I'm expecting the market to make a bigger move. And if it doesn't make a bigger move, I'm still going to play upside on the SPY, playing those dailies, you know, following the counter trend, things like that. But for the most part, I'm expecting the stock market to have some big moves. I bought a little bit more contracts than I would like. No, what? I bought more contracts because I expect this move to be really sharp, and I want to take advantage of that. The next trade I have for you guys is going to be XLK, and this is the technology ETF. Now, with being Nvidia, a tech company and one of the biggest companies in the world, a part of the Magnificent Seven, if they disappoint on earnings, XOK is going to fall off a cliff, and that is why I bought these 200 puts, and they're actually doing pretty good, almost $100. And I bought three of these. I thought they were cheap, so I said, hey, let me get in, and we're almost in the money on these. And if we take a look at the market right now, yeah, we're lower than the close of Friday. So, oh, that's the XOK chart. Whoops, my bad. If we take a look at the SPY chart, we are lower than the close on Friday, hitting 498. That is not a good sign going into the next week. So, with that being said, I got these XOK puts. We're almost in the money. I plan on holding these in case technology really starts getting out of hand. I went with less time on these because I didn't like the further out contracts. They're a little bit expensive for me, and I bet that Nvidia earnings is going to drop the technology sector a hefty amount, and I went closer to the money as well. I got almost $100 of profit on that, so we'll keep a lookout on that. And I made a bond trade, but I'm still down on the bond trade. I'll just show you guys anyways. I'll just show you guys anyways. Yeah, I got the May TLTs. You know, these are now worth. I got the May TLTs from 110. They're worth like 10 cents. You know, I bought 3 contracts. I might buy more depending on, what happens with rates and things like that. I do expect the Fed to cut at the first half of this year, but as we're getting into the year, it's looking less and less likely that they will. But at the same time, there's different economic factors that will cause them to cut. So I'm expecting, these unforeseen events to happen, and I'm expecting them to cut. I am going to be buying more TLTs. Maybe when this contract gets to 10 cents, I'll buy, 10 contracts. We'll see. But I like to keep the TLTs cheap because, like I said, if you can keep them cheap, then you can really outsize your gains on those. Now, let's take a look at everything else that has been going on in the market. The fear and greed index. This is another key factor as to why the market is going to drop next week and continue to fall. We are in extreme greed, and we've been in extreme greed for the past week. We almost hit an 80 reading, which is really, really rare. But not only that, you have been in greed for the past year. And if we take a look at the market momentum, look at where the 125-day moving average is. It is at 4,600. Now, guys, when I tell you that if you see extreme greed all over this chart, you are in for a rough time. And as well as market volatility, it has been neutral. So you've had little to no volatility ever since October. So with that being said, I expect market volatility to start ramping up heavy, and going above this moving average, because you can see it's starting to turn, and it has been a wild ride. As well as puts, nobody's been buying puts on the market. Puts are extremely cheap. They are extremely cheap. Everybody's been buying calls, because they're just expecting the market to continue to go up. So you have to be weary of this. You also have market breadth. Market breadth actually ticked up last week despite all that's been going on. But as you can see, when the rally started, market breadth continued to climb higher, and then it fell off. And then I expect market breadth to get worse as time goes forward. Now, let's take a look at the bond market. You're at 4.2. Now, 4.2 is a key level because if you remember, once you hit 4.3, the stock market cannot ignore it no longer. It can't. And then once you hit 4.5, you start running into issues. Once we hit this 4.5 level, that's where you had September and October, really volatile months. So you got to keep that in mind. The bond market is screaming right now, and as a matter of fact, it was dropping off on the anticipation of the Fed cutting. But now that you don't have that no more, it is going to be really, really hard for the bond market to say, look, the Fed is going to cut by the end of this year, which I think they're both wrong. I think they're going to cut, earlier than expected. But let's not get too ahead of ourselves. I'll make a different video on that. But if we take a look at the watch tool, you have completely priced out March rate cuts and May rate cuts. This used to be, 80%. You have completely priced out the March rate cuts, and even the May rate cuts, you have priced that out completely. Now, for June, however, June is an interesting month, because if you get another bad inflation report, you could price out June, and that's really going to hurt the stock market. And that is why the stock market has been rallying off the October lows. It has been because the Fed has been cutting rates, and it has been because, not cutting rates, but they anticipate the Fed cutting rates, and they think that the Fed is going to cut rates because that's what they anticipated. But if you have inflation soaring like this, unemployment staying where it is, the Fed is not going to cut rates. They are not going to cut rates. They're not going to do it. Now, with that being said, if you get another bad inflation reading next month and you see these priced out, you better expect a bigger drop in the market, because this entire rally has been based off of the Fed rate cut fiasco, right? So, and I got a little tidbit for you guys. Seasonality. Now, in terms of months, February is an up month for the S&P 500, but if you take a look, it is a down month for the NYSE Composite and the Nasdaq. Now, what does this all mean? Even though we've been up for, most of this month, February is usually a down month. So we are going to get an aggressive sell-off coming into February and March. And if you take a look at March is actually an up month for the Nasdaq and the NYSE and the S&P 500. So the stock market could fall off a cliff and then rebound back up, like never seen before. Just like last year with the banking crisis, you had a aggressive sell-off and then immediately a rip higher. So you got to keep that in mind. Leave this chart, save this chart, save all of this, so that way you can be aware of what to do, and what months appear. But why I say the stock market is going to fall next week is because take a look at the week months for the Nasdaq, February, and the Nasdaq has been carrying basically the entirety of the stock market. The Magnificent Seven, what is it? It's a tech sector, basically. It has just been 7 tech stocks running the entire thing. And if it's a weak month for the Nasdaq, that means the Magnificent Seven is going to be extremely weak. That means a sell-off is likely to occur. Now, I have shown you guys all the evidence as to, what's going to happen next week. I'm also betting onto the downside. So, with that being said, I hope you guys enjoyed the video. Drop a like down below, comment and subscribe. I miss you guys. I'm going to upload another video real soon, so be on the lookout for that. It has been your boy Young Soros out.